Good afternoon, everyone. My name is Neil Ross. I'm Managing Director, National Sales with Ninepoint Partners, and it is my great pleasure to welcome you to our precious metals call, Gold Surges, 2,000 ounces and beyond. Before we hand things over to our featured speaker, I just wanted to cover a couple of things that are of importance. One is for all the new folks on the call that maybe don't know Ninepoint terribly well, maybe know our brand but don't know us intimately. At Ninepoint Partners, we're an asset manager focused on alternative investments. So that is our absolute focus. And for us, alternative investments are not merely enhanced funds or enhanced long strategies. For us, alternatives are things that have a low correlation to the stocks and bonds that you own, or in some cases, like with our quant strategy, no correlation to the stocks and bonds that you own. And, ultimately the role we play in asset mixes, whether you're a discretionary advisor, whether you're an institutional investor, whether you're a financial planner, whatever your role is in the industry, that we do things that you provide funds and mandates that you typically wouldn't do yourself, and that offer true diversification when added to a traditional stocks and bonds portfolio. At Ninepoint, we have a long track record of managing and overseeing alternative income funds, real assets, alternative core strategies, and of course, included in this is resources and precious metals. Ninepoint Partners has almost 80 employees. We have both the Toronto, Montreal office, and the total of our retail and our institutional assets is approximately $6.8 billion. So maybe you don't know us well, but we're actually not all that small of a company, and we are right here in Toronto. If we could just move to the slide talking about the 4 different mandates. So for us, we're offering you folks on the call 4 ways to participate in what we think is a very attractive entry point for precious metals. So that means that we have our Ninepoint Gold and Precious Minerals Fund. This is a stock fund. It's been around for a long time. It has very attractive performance. And that would be for folks, who are looking for leverage on the commodity. So if you really believe, and I think a reasonable person would, that it's a great entry point for gold, the way to get a multiplier or leverage is to own gold stocks. And then we have something special that is not really available many places. We have a Silver Equities Class, so a Silver Equities Fund. And I'm sure that Maria and Shree will talk about that fund. I know they talk about it later in the deck. It's a good seller for us. It's a sort of a unique fund and offers a particularly attractive way to benefit and get leverage on the price of the appreciating price of precious metals. Now, for folks who are looking for something that is less levered to the commodity, we have a couple of bullion funds. So we have a Ninepoint Gold Bullion Fund and also Ninepoint Silver Bullion Fund. And these will give you exposure really to the raw commodity. It is not going to give you leverage on the underlying commodity, but if you're right, and we think a reasonable person would want to own these types of investments at this time, you will benefit from the appreciation in the price of gold, or for the Silver Bullion Fund in the price of silver. A really important thing too is that the underlying assets are actual bullion. So these funds don't contain paper gold or obligations from another party to deliver gold at another date. You actually own, the fund has its own dedicated bars, so that you won't have any trouble, of course, through the market dynamics, actually realizing any of the assets. So fully backed by real bullion, not paper bullion. If we could go to the next slide, please. So at this point, I want to turn things over to our featured speakers. We have 2 today. One is Maria Smirnova. Maria is a senior portfolio manager with Sprott Asset Management. Sprott is the sub-advisor to these funds. Maria joined Sprott as a research associate in 2005 became an associate portfolio manager in 2010, a full PM in 2014, and a senior portfolio manager in 2017. Maria is part of the precious metals team and manages the Ninepoint Silver Equities Class, and of course the Ninepoint Gold and Precious Minerals Fund. Maria has 20 years of experience in the industry, began her career at Excel Funds, worked in product development at Fidelity Investments. Maria is a graduate of the University of Toronto and is a CFA charter holder, and also importantly, a Bregman Scholar from the U of T's MBA program in 2005. So also speaking today is we have Shree Kargutkar. Shree is a portfolio manager also with Sprott. He began his career at Sprott a decade ago, and during this time has run both long and long-short strategies at that firm. Shree specializes in precious metals and commodities investing and is able to take advantage of his experience in derivatives across various mandates to implement risk mitigation and income generation strategies. Shree is also an MBA from the University of Toronto in 2011 and has also a degree, a BA from New York University, and is also a CFA charter holder. So our esteemed colleagues will take things from here. So folks, I'll hand things over to you.
Thank you, Neil, for this very nice introduction. As Neil said, my name is Maria, and I will talk to you, and Shree and myself will talk to you about the case as we see it for both gold and silver, and both for bullion and equities. And as Neil highlighted, we sub-advise 4 funds for Ninepoint Partners, so we cover both equities and the physical bullion. So I'll start on slide 5, and let's talk a little bit about our case for gold and silver investing. And this slide I use all the time. I'm sure a lot of you have seen this slide. It simply highlights the finances of the United States government, and I use the U.S. as the leading, global economy, and just to highlight what's happening all over the world. But I use the United States as an example. And as you can see, the green line that shows the U.S. budget balance, it basically fell off the cliff in March, at the beginning of this year, when the COVID pandemic hit. And of course, when government finances are strained, the Fed lowers interest rates, and that's exactly what they've had to do this year. Mind you, they did that last year as well, pre-COVID, as there were signs that the U.S. economy was weakening. Now, this again is just an example, and taking you to slide 6 now, I wanted to show you what I call whatever it takes, and it is the global government's response to the COVID crisis and to the weakening global economy. And you can see across the board, both central bank, monetary injections, as well as government fiscal stimulus has been quite extensive and in fact unprecedented to combat the weakness in the economies. 44%, and this is as of May, mind you, so the numbers I'm sure are higher now. And of course, as you know, the U.S. is debating yet another phase 4 package of stimulus as well. So these numbers will definitely go up by the time it's all said and done. But the numbers are astounding: 44% of U.S. GDP, 35% of European GDP, and globally 25%. So this is very positive for gold and silver. This speaks to, again, trying to figure out how to finance liabilities, how the increasing debt associated with that, and ultimately what it tells you is this fiat currency debasement, and that's exactly why this is positive for gold and silver. And this is not a one and done. I think that the global economy will have a tough time recovering. Many people right now are talking about a V-shaped recovery. However, I think of course, right off the bottom, we can see better employment numbers and a resurgence in economic activity. But I think longer term, we're not going to see stellar growth rates that some people are anticipating. So then let's turn to slide 7. One of the effects of what's been happening in the world is an increasing amount of negative real rates around the world. Both in Europe and the United States, we're seeing negative real rates. And real rates, all they are is you take the nominal rate and you subtract inflation or inflation expectations and you get your real rate. And that's exactly what we're seeing. And gold specifically tends to perform really, really well in times of negative real interest rates. We've seen it, this is why the chart goes to the 70s. Periods A and B that we highlight were periods of runaway inflation. They were largely caused by oil price spikes at the time, but it led to a spike in the gold price. And then recently, of course, period C highlights the global financial crisis when we saw quantitative easing and again, cuts in rates. But again, gold did really well in that period. And of course, we're seeing a similar effect right now in period D. Now, again, gold actually, and I'll highlight this later, but I think it's not just the COVID crisis that's driving gold. We were seeing weakness in the economies and lowering of interest rates even prior to this crisis. So again, I think the fundamental macroeconomic backdrop is very positive for gold and silver. On slide 8, let's move on to slide 8. In the last 10 years, one of the drivers for fundamentals of the gold market anyway was a return of central bank buying of gold. In the 90s and the 2000s, central banks were overall sellers of gold bullion. But then the switch flipped 10 years ago, and we're seeing buying again. Now, I wouldn't expect necessarily strong central bank buying this year because, again, government finances are being strained across the board. So, for example, Russia paused their external gold bullion buying. They may still buy internally in the country, but not from outside the country. So, but this is a positive trend where especially emerging market central banks are diversifying their FX reserves away from the US dollar and into gold. Very importantly, on slide 9, I'm showing ETF inflows into both gold and silver ETFs. And these are hitting record highs. For example, for silver specifically, we've seen about 280 million ounces go into the ETFs in the last 5 months alone. And that, if you think about the silver market is only 1 billion ounces a year. And so that represents over a quarter of the annual market. Those are astounding numbers. So we are seeing strong investment demand. And if I were to comment also about coin demand, which is also a measure of investor demand, coin sales have been spiking as well, particularly in silver, but gold as well. So we're seeing a strong reaction in terms of investment demand for gold and silver bullion. If we were to talk a bit about, technicals of the gold price on slide 10, this is a simple chart of gold. Why do you want to show this? Well, simply because many people ask us, well, have we missed it? Have we missed the rally, and is it too late? We don't think so. Given the macro backdrop, we don't anticipate changing. We don't anticipate that real rates will, go higher much faster in the next few years. I think the macro backdrop remains very positive. And on a technical level, gold broke out through its range at 1350. I think it happened in 2019, and it was off to the races ever since. So it is in a strong structural uptrend, and we're obviously enjoying this environment, but with a view that there will be corrections. Nothing goes up in a straight line, as I like to say, but we're pretty positive on gold. And here's another chart on slide 11. Just for fun, we decided to graph the gold price adjusted for inflation just to see where previous peaks have been. And you can see that back in 1980, the peak was actually at about $1,100 adjusted for inflation. Well, and right now it's sitting under $800. So we still have a ways to go just looking at it in those very simplistic terms. But again, I would caution to use comparisons like this because we've not been in such an environment before where central banks around the world are full bore ahead, trying to print money, provide stimulus to stimulate their economies. It's a currency war, and it's you can call it many things, but basically I think that the environment is very positive for gold, and I can't say that enough. So turning to silver then, on slide 12, I did want to comment on silver. If you looked back at last year, and on slide 12 I show the gold to silver price ratio, if I was talking to people last year, basically silver was given up for dead last year. Nobody believed that that silver could rally and would rally at some point. And particularly when silver sold off to $12 in March, I heard a lot of the arguments of why silver wouldn't rally or couldn't rally going forward. And of course I said, let's look at the case of the global financial crisis in 2008, where silver did sell off more violently than gold as well. However, in the months and years after that, as again interest rates were lowered and as quantitative easing took hold, silver actually outperformed gold until 2011. So there was a period of 3 or 4 years where silver did significantly better than gold, and that's exactly what we're starting to see here. And that's just simply looking at this gold to silver price ratio. So we're quite excited about silver's prospects here. Let's look at slide 13. Simple price chart. Again, silver broke out through 21-22 resistance, and it's been off to the races. The last peak was in 2011 at close to $50 an ounce, and we're about halfway to the last peak. So there's lots of upside left in silver. Again, on slide 14, for fun, I graphed the price-adjusted silver price. And wow, look at this, $10 right now, price inflation adjusted, it hit almost $70 or $65. So again, just showing silver is very volatile, there's no question. But, again, I think there's a lot of upside remaining as time goes on. So at this point, I'll turn this over to Shree, and he will talk to you about how we view gold and silver equities, and why we're excited about the equities, basically. Shree, over to you.
Thanks, Maria, and thank you all for your time today. As we have noted in our previous commentaries before, we are in the early innings of a bull market in precious metals and precious metals equities. And when you look at slide number 15, it goes to show the improvement that has taken place in the precious metal equity landscape over the past 10 years or so. So coming out of the bull market, the previous bull market, which ended around 2011, and back then the gold and silver producers, by and large, were generating around just north of $500 per ounce of margin on an all-in sustaining basis. In the following several years, so all the way from 2011 to 2016, 2017, they were faced with multiple headwinds. The price of gold and silver were coming off. Their cost profile was starting to look quite bloated. Their balance sheets needed to get fixed as well. And so the industry at large really went through a belt-tightening exercise whereby they had to improvise their operations, make them more efficient, and make them more profitable. They had to adapt to the lower gold price environment that they found themselves in, and they had to adapt themselves to this new sort of paradigm that they found themselves in, which is where gold was trading in between a range of $1,200 to $1,400 for multiple years. And they came out on the other side in a much better shape. And this is quite common in a lot of commodity industries that have been faced with multiple years of stagnation on a top-line basis. So coming into 2020, the AISC margin for these companies had shrunk by almost $400 per ounce compared to their 2011 levels. So currently, even including some of the escalation that we see from COVID-related expenses, the overall all-in sustaining cost for the industry is roughly around $1,000. So this number of $720 that we show on the presentation here was actually done using $1,700 gold as an estimate. Things have changed very rapidly in the past few months, and we are closer to $1,950. So that AISC margin has actually shifted higher to about $950, which is almost 2 times higher where it was in 2011, back when gold was at similar levels. So that is a very exciting development to showcase in the precious metals mining space. And shockingly and surprisingly, and this is on slide number 16, as Maria pointed out, gold and silver bullion ETFs have seen massive inflows over the last little while because, mind you, there's $15 trillion worth of negative yielding debt across the world. There really is no such thing as a good sort of a fixed income holding anymore, which has low risk. So people are gravitated towards high yield. They're gravitated towards more private equity style stuff. And due to all the monetary activity that is occurring around the world, the metals that cannot be printed, like gold and silver, have been attracting a lot of inflows as people seek to diversify themselves away from these low or negative yielding bonds and into some other safer assets. But surprisingly and shockingly, as I said before, the inflows into the precious metal equities for the past 2 or 3 years have remained negative, and meaningfully so. So let's look at the GDX and the GDXJ as proxies. So starting from 2019, the GDX has lost around 15% of its units outstanding in the same time frame. The GDXJ, which is composed of junior and mid-cap gold and silver producers, has lost almost 25% of its units outstanding. So while gold and silver are in a bull market, and their prices reflect that, the equity investors putting money to work into precious metal mining companies are not really calling it. They're in disbelief as to what is occurring, despite the record margins that the mining companies are pulling out, despite gold having taken out its previous highs. And this is not exactly something which is, I would say, uncommon, because in most early stages of the bull market, people are a little bit shocked with how quickly prices can rally, and they're oftentimes, they meet that rally with disbelief, and they pull the plug and they take their money and move on somewhere else. As the market matures, obviously, we start to see a little bit of increased inflows back into this space as optimism starts to take hold that indeed this sector has the right kind of mix of structural tailwinds as well as good levels of profitability. And currently, we do have the elements of both. On slide number 17, it goes to show just how cheaply gold equities are trading at in relation to spot gold. And if you were to buy a random gold stock today, or a basket of random gold stocks today, rather, it would almost be like you're buying gold at $1,800, which is around a 7% discount to where we find the spot gold price at today. And that discount was even higher a few months ago. It has started to close. But in a bull market, equities typically lead the metal. And it is very common to actually start to see gold equities not discounting, but trading as if gold were to move higher and continue to move higher. And this is exactly what we saw in 2001 all the way to 2010, with a few exceptions here and there. But by and large, in a bull market, the discount should not be in place. And this discount window that we're currently seeing in gold equities seems like it's closing quite rapidly. On slide number 18, when I spoke about the record level of ASIC margin that gold and silver producers are taking out, and in the previous slide, I just shown how gold companies are trading at very inexpensive valuations. In fact, at a dislocated price compared to spot gold, one would expect that the price to cash flow multiples or even free cash flow yield, any such metrics would be cheap today relative to where things have been, and that is indeed the case. So if you look at this chart, it goes back almost 13 years, and gold producers today are trading around 8.5 times the price, 8.5 times price to cash flow today. Silver producers are trading just south of 12.5 times price to free cash flow today. And in a bull market, we typically see these multiples be close to double the levels that we currently find in a typical normal bull market. But this is, again, as I said, the early innings of a bull market, and there's still a big catch-up trade for these equities to still deliver on. On slide number 19, this is a theme that I've been hearing about from a lot of people that look at the quant models, and a lot of people, even on the fundamental side. The S&P 500 and its earnings over the past couple of years are actually now projected to decline by about 25% of its levels that they were at the beginning of 2019 as a result of COVID, obviously, and the ongoing economic weakness that we're currently seeing as well. No one knows how long the S&P 500 earnings will remain depressed for, but because of the increasing price of gold and the increasing price of silver, the precious metal companies are generating massive increases in earnings per share growth, and that will attract a lot of eyeballs, and it will help wipe away some of the disbelief that we're currently seeing in the space, whereby equity investors are pulling their money out. Gold equities are trading at a discount to spot gold prices, despite having the highest margins. Once the earnings per share growth starts to come into focus, and indeed it has been, we'll start to see this sector really start to move meaningfully higher into the next phase of the bull market. So on slide number 19, I talk about how Newmont, Goldcorp, and Agnico, which are some of the big kind of bulwarks of the gold and silver mining space, they're looking at having increased their earnings by over 150% since January 2019. And on slide number 20, this is just a selection of some of the mid caps which are in our portfolio. This is where we think the sweet spot is for gold and silver investors today. It is in the mid-cap space. This is where our portfolio is positioned. This is how our portfolio is differentiated versus most of our peers, and this is something that Maria will touch on later. But the earnings growth that we're seeing out of companies like Kinross, B2Gold, Dundee, Precious Metals, these are all holdings with us, are just stunning over the past year and a half. These companies have been able to grow their earnings as high as 450% in the case of Kinross, which is quite nice to see. And we think that as the gold price and the silver price starts to continue its move higher in a structural bull market that we are in, the growth in the EPS will certainly continue to accelerate and will continue to attract more eyeballs into this space. Slide number 21 talks about what we are looking at in terms of an opportunity. And the opportunity in the space is enormous. In the previous bull market that we saw in 2001, which ended in 2010, 2011, the price of gold appreciated by 550%. In that time frame, the Huey Index, which is a collection of some of the largest gold mining companies, returned north of 1,500% over the same time frame. So silver equities, gold equities, they both provide leverage to rising metal prices, and they have done so. We saw a similar type of a move occur in the 1970s, which was the bull market preceding the early 2000 bull market. And as we enter the current bull market in gold, with gold trading at an all-time high and looking to move higher, there is an enormous opportunity. And if you are an investor in gold and silver equities today, what you'll be able to get into would be finding very attractive valuations and equities that are trading at a very steep discount to the current metal prices, along with rising EPS. It's a very phenomenal combination. It's a very potent combination, which can deliver some outsized gains for investors in this space. I'll turn it over to Maria so she can cover some of the details around our team and our funds.
Thanks, Shree. Let's turn to slide 22 then. You see here the Sprott Gold team, including the executive team and ourselves as well, of course. So you can see we have quite a number of individuals involved. Of course, all of Sprott is involved in the resource space and in the precious metal space. But in terms of the actively managed mandates that we manage, these are the people that are involved. Interestingly, in the last few years, when the gold kind of management area was suffering and people were shutting down funds and, bad things were happening, we actually were proactive in looking for new opportunities. And at the end of last year, we acquired the Tocqueville Gold Strategies team. And that brought to us John Hathaway and Doug Groh, both of whom are very, very well known in the sector and have managed precious metals money for years. And of course, John's very well known in the space and writes fantastic articles. So we were very happy to not just acquire their assets, but to acquire the individuals who manage the assets. And of course, now we're a big team, and we talk every day. We exchange ideas. John and Doug still, they have mandates that they manage in the United States, and we have mandates in Canada. So it's a great relationship. It's been great to learn from very experienced managers and frankly exchange ideas back and forth. And then we are, of course, supported by technical advisors that we have at Sprott. They're mostly U.S. based, but Neil is in Vancouver and Justin is in the U.S. So we have a great depth of resources. We're specialists. This is what we do. We understand gold. Call us gold bugs if you wish, but we have many years of doing this, and we know where the bodies are buried. Okay, we've learned, and again, this is another wonderful thing about John and Doug. They know management teams for decades, so they know the people for longer. They have more experience than I do, and Shree does. So we've learned a lot, and I think we're very excited to have this great team in this environment. So let's turn to the funds then. On slide 23, we have the Ninepoint Gold and Precious Minerals Fund. This fund has been around since 2004. It was managed by other individuals before us, before we took it over. So I will only speak to how we manage the fund, okay? How Shree and Jason Mayer and myself do it. So our focus is really, as Shree pointed out already, on the small to mid caps, and particularly the mid cap producers. And you see a bunch of them in the top 10 holdings. These are the companies that are generally able to grow their reserves and grow their production. They're not too big, for their own good kind of thing. They are adding ounces to their reserves, and there's lots of catalysts that they have to increase earnings and free cash flow. And we focus a lot on free cash flow when we analyze companies. So I would say that the portfolio right now is pretty focused. We have under 50 names in the fund. Top 10 names are about 40%. So at the same time, we're focused, but we're not concentrating the fund in any one name. We don't have, as you can see here, top 10% holdings. Our biggest holdings, 5%. So as you know, mining space is kind of hard, and there's some blow-ups that happen time to time. So we try to avoid those, not just through research, but to also not placing big bets on any one name. And I think that's how we differentiate ourselves too from our competitors. So again, focused, not too many names, but at the same time, not too concentrated. Right now, we have about 80% of the portfolio in producing or royalty companies, and the rest is in exploration companies. About 20% of the portfolio is exposed to silver right now, and we've been actively looking for new ideas in the silver space, and I'll talk to that more when I talk about the silver class. So we've also tried to participate in some private placements lately. That gives us access to warrants, and that is free upside, essentially. And that's about it. And I will also add that we are very, very global in our approach. We have over 20% of the fund in Australian companies, for example. We have a number of companies in Africa, Latin America. So we're definitely global in approach. And that is why it is nice for us to have our technical advisors who pound the pavement and visit a lot of mines a year. Well, until COVID anyways, they did. Shree and Jason and myself also try to get out and visit as many mines as we can. We go to Australia, we go, I go to Mexico, States, Canada, of course. But we try to cover the globe and actually see a lot of these companies. And our performance is starting to reflect that. We are not an index plus fund. We try to differentiate ourselves by finding new and different ideas, especially in the exploration side. We do not own names like Barrick and Newmont or Agnico Eagle for that matter right now. Our names are kind of more below the radar, interesting names. So I think that covers the nine. Yes?
Yeah, I just want to interject, Maria, and also just draw everyone's attention to the fact that both the Gold and Precious Minerals Fund and Silver Equities Class have since inception outperformed their benchmarks. So the good work done on this fund and the experience of the sub-advisor really comes through, and it has been a very solid performance with your active management.
Well, thank you, Neil. Let's go to slide number 24, and I'll speak to the Ninepoint Silver Equities Class. Arguably, I always say that fund we launched at the worst possible time at the beginning of 2012, just at the top of the market. So it's been a bit of a tough slug, but again, recognizing the opportunity that we had on our hands last year and the year before, I've been positioning the fund slowly but surely to new ideas. I have been very aggressive in looking for new names to add to the portfolio on the exploration stage. And in fact, right now the fund is about a third exploration and 2/3 production. Now you'll see Wheaton Precious Metals, the old Silver Wheaton, is north of 10% here. It's now south of 10%. It's been a great source of cash. It's a great company. However, it's been a great source of cash for me to redeploy into other smaller names. The rest of the portfolio, I would say the top 10 holdings anyway, most of them are still producers, as you can see. There's a bit of a new top 10 name called Discovery Metals. They have a very exciting project a very large project in Mexico, and they've been doing a great job kind of building that resource and trying to make it better. So I would say that's about it for me. I will turn it back to Neil.
Thank you, Maria, and thank you, Shree. We have a number of questions, and I think maybe we'll just we'll throw them at you rapidly here, and we can get a quick answer on each for our listeners. The first one would be, I think we've already talked about gold equities versus bullion, and you did show a slide that over time in bull runs, equities outperformed by a rate of about 3 times. So I think that one has been answered. Do you have a target on the price of gold? Some have talked about $3,000 for bullion in the next 2 years.
So we don't have official targets. We're money managers. We're not sell-side analysts, but we're certainly seeing $3,000 targets spring up. I think I even saw a 3,200 target from somebody spring up left, right, and center. I think what anchors me is again the macro backdrop, and the conviction that we have in this that we are in this environment for several years yet. And so if we've gone from 1,300 to 2,000 pretty quickly, I mean, if this persists, there's no reason why we can't reach 3,000. I think that's my view. I don't know if Shree has a different view on that.
I don't really have a view on where the metal prices are headed, but if you were to look at the previous cycles, in gold, for example, gold was around $100 an ounce before the bull run began in the 1970s. It ended around $850. So that was almost an 8x return. In the early 2000s, gold was around $250. It ended up around $1,920. That's again 7.6x return. Gold bottomed out just north of $1,000 an ounce in the most recent cycle. So usually, if someone were to come up with a target price, the market has a way of making everyone look stupid. But we're, again, as Maria said, we're just trying to pick stocks that make money in the current environment, and even if the price of gold or silver were to drop a little bit, they'll still be profitable.
I have a question here about where we are in this bull run. Can you guys just kind of cover off how these develop? I think you spoke to it a little bit, but I do have a question. Bullion starts to move, and then the stocks start to move, and it kind of happens in about 3 different steps for 3 different kinds of assets. Do you know what I mean? Like first the bullion, then the large caps usually. Do you want to just maybe kind of cover that one more time, or just address that?
Sure. So in our previous commentary, we had written about the evolution of a bull market, as well as just how the market cycle tends to play out. And coming out of the bottom, when you're just left with people in despair and a lot of tears, the first initial move higher is what I've kind of been referring to as the disbelief phase, whereby the price of the metals move higher, there is interest in the bullion, and there is some early interest in the large cap liquid names where people are just trying to probe into the space and see if there's still longevity to this move. And that's followed by a phase of the disbelief, that is followed up by a phase of optimism, whereby people believe that the metal prices are in a structural uptrend. They believe that the equities are delivering the kind of leverage that they were initially hoping for. And that's when we start to see assets start to flow, not only into the large caps, but also into the mid-tier and into some of the higher quality junior mining companies. We are probably close to that phase right now. We're starting to see some financings get done. And finally, and this is what we saw in 2010 and 2011, is the euphoric kind of blow off top when prices go parabolic after having established all-time highs, and equity analysts around the street are discounting ever rising, ever higher prices of the metal. And that typically tends to mark your peak in the bull market. And obviously, we're not seeing anything close to that, like that right now. And knock on wood, seem to be quite properly valued here.
Yeah, I think that given the historical pattern of how these bull markets develop, it would be very hard for a reasonable person to take the view that they have, quote, missed their entry point at this time. I mean, it would be very hard for a reasonable person to take that view based on historical pattern. Question is, we see some smaller companies in the Silver Equities Fund. Do you participate in private placements?
Yes, as I mentioned, we do. We have been. And I mean, private placements are great because you know, they allow you to have a substantial, to put in a substantial amount of money if you wanted to. And it also oftentimes, especially in Canada, they will come with a warrant or half a warrant, and that provides, you know, quote unquote, free upside down the road for more of, so if things go well and if things work out with the story, then you get additional upside.
Okay, thank you. Just scrolling through the questions here for some fresh subjects. I guess one final question here. I think you spoke a little bit about it, Shree, but just about events that could derail this gold rally. Could you just speak to that a little bit?
Sure.
Like, what would be the worst?
Maria,
taking a pessimistic view, what would be what would one watch for?
There's two things. A big rally in the U.S. dollar. A big rally in the U.S. dollar, because most people look at the U.S. dollar gold tape and not gold measured in the Canadian dollar terms, which made took out its previous high 4 years ago, versus the U.S. dollar highs being established just last month. But if the U.S. dollar were to rally in a meaningful manner, that would be negative for gold, for starters. And the second thing, and this is something Maria had pointed out to before, is real rates and central banking policy. So currently, central banks around the world have stated that they have no intention of raising the rates until the economic recovery is firmly in place, which means that real rates will likely remain negative for the foreseeable future. But if for whatever reason the central bankers decided to change that stance and move rates higher meaningfully in a much shorter order than what they had previously envisioned, that would be quite negative for gold. Maria, do you want to add anything?
Yeah, no, precisely. And just generally speaking, a change in economic policies, right? Particularly monetary policies, which I have a hard time seeing, but could happen.
It does seem to be an unlikely turn of events. Okay, well, I'd like to leave it there. We've covered the main themes and the questions. I want to thank everybody for your participation. I would say in closing, we have a very veteran manager, a manager that has outperformed its benchmark since inception. Ninepoint offers 4 funds, 2 giving you a participation in bullion and the commodity, and 2 giving you participation in the stocks, which will give you more leverage to the upside, historically 3 times in a bull run. And we feel very strongly that it's a very attractive entry point, and that looking at the patterns of past bull rallies, we are in early days for this bull rally in precious metals equities. So thanks again, everybody. I hope you have a great rest of the day, and we look forward to getting time with you again in the future. Thanks.